In this video, I'm going to show you how easy it is to use point and figure to find really choice trade locations and how to avoid getting in when it's really, really choppy prior to some kind of a move. Now, sometimes we're going to see moves that are really massive, really big. We all know what causes those for the most part, and if you follow along with the information in the modules that I'm teaching you how to analyze the phases of consolidation, you can pretty much detect when it's just about ready to break out and create that big, massive trending move, whether it's to the upside or to the downside. And then we still use point and figure to calculate that, so we want to find and pinpoint the precise entry with point and figure. And then with point and figure, we're also using it to give us a very accurate price target so that we don't hold on to a trade too long. That's one of the biggest challenges. When I first started trading back in 2001, I would get into a trade based on candlestick patterns or bar chart patterns like this. And what you see here, this is a 60-minute chart of the pound dollar. But what would happen is I didn't have an accurate method or a method that was accurate enough. And it was because of my inexperience, of course, but I didn't have a method of being able to calculate how far price would likely go. So in other words, how long could I hold on to that trade? So what I found was very often, and I see this with most new traders and even experienced traders that have been doing that, making the same mistake over and over again. They get into a trade and they don't know how long they can hold on to a trade. So let's say you get into a trade one day and you take, let's say, 9 or 10 or 11 pips, and you're pretty satisfied with it, especially if you're trading standard lots. That's not too bad, right? And then you realize that it keeps going for another 20, 30, or 40 more pips, and you're wondering, how do I capture most of that move? What can I do to get more of it? You start thinking to yourself, and you've heard the term, you're leaving a lot of money on the table. So then the next time you find a trade that looks similar, and this is, of course, if you don't have a method of being able to calculate how far price is going to go. So the next time you find a trade, you remember that you left a lot of money on the table, right? You could have got more. So then you find that a setup that looks the same, and you get into the trade, and now you hold longer. You hold longer. So now you exceed the normal 7 or 8 or 9 pips that you would normally trade to, and you're hoping that this time it's really going to turn into something that's going to result in like 20, 30, or 40 pips. And all of a sudden, it doesn't go anywhere. It reverses. You hold on too long. You don't take your 10 or 9 pips or 11 pips, whatever it was that you did in the previous trade, and the whole thing reverses, and then you get stopped out. So then you think, well, none of this is working. So what can you do? And that's where point and figure will help you. I'm going to show you exactly how to solve this problem today. This is exactly what I teach in my coaching course. It's really easy once you get the hang of it. Of course, you're going to have to make some adjustments when you start looking at point and figure because it's not normal. It's not something that people normally start off with in the beginning of their trading career. So you can see that this is, again, a 1-hour chart of the pound dollar. And to me, when I see this, and of course this is just the way that I see it. You might see things totally different than I do. That's okay. There's nothing wrong with that. That's what trading is all about. But I want to show you a simpler way to get into the trade so you don't have to sit there and stare at the charts all of the time. You can set up alerts so that when it actually starts to break out, you get in when the momentum is taking place and you're in the trade a lot less time. And it takes a lot less time to go from your entry to the expected take profit target. It rolls pretty quickly to that because you're riding the momentum to that take profit target. So this is pretty choppy. I think we can all agree that this is pretty choppy, and we can find some little levels of support and little levels of resistance that might give us an opportunity to jump in, but I don't want to scalp. Scalping takes a lot of time. There's nothing wrong with scalping, but scalping takes a lot of time. So this is for the person who it can day trade, but doesn't necessarily have all of the time to sit there every single minute waiting for every single candle to close, and then you start going down to like really small time frames, and you're just scalping. You're just taking 4, 5, 6, 7 pips. That can get pretty exhausting. Again, there's nothing wrong with it if you have a successful method or means or system to trade like that, but I prefer not to, right? I've been trading for a long, long time, and I like to slow things down and take really specific choice opportunities and then leave the rest of it alone, and then also look at larger time frames. I'm also using the same strategy to trade stocks. I also invest in certain stocks, so I might be in certain stocks for 6 months to a year, but this is going to give me the opportunity to day trade as well. So I'm making money daily in addition to some of my investments that I'm trading for the long term. I do the same thing with currencies. I hold on to some of these trades for several months. That's a separate account, but I can also day trade. So this is for day trading purposes. So you can see it's a little bit choppy here, and there's a little reversal right here. This candle, I'm going to highlight it right there, this bar. And that's a bullish engulfing candle. Now, there's no volume here, but volume would definitely help me in this case because I'm counting the waves. That's another strategy that I teach, another system that I teach inside of my trading course. It helps you identify and pinpoint these turning points. But it still looks like it's still in this little range of consolidation here. So that's what I see. So I want something that's easier, something clear, something simple to see to get me into the trade. Let me show you what it looks like. So this is my point and figure chart, and this is For the most part, I've constructed this chart to resemble or to mimic that 1 hour time frame on the pound dollar. You can see the same range of consolidation that I showed you in the previous bar chart. This is exactly what it looks like right now. So this was my entry. Here was that range where I said it was a bit choppy, and then I saw that one bullish engulfing bar, which was also a candle. You can use a candlestick. I use candlesticks occasionally, but I prefer bar charts. Nothing wrong with it. Again, candlesticks work just fine. I use both of them sort of interchangeably, depending on what it is that I'm looking at. Sometimes I'm just scanning the charts, so I'll use candlesticks because some of the reversal patterns will stand out very, very clear. And then when I'm looking and I'm counting the waves with that method that I mentioned, I teach that in my trading course. That helps me pinpoint these reversals. When I'm counting the waves, I'd rather use a bar chart because I don't want to rely on the candlestick patterns to help me confirm the reversal. I want to rely on supply and demand to help me confirm and identify the reversal. So here, this point and figure, this is not based on time. So it isn't that where you see one column, each one of these columns represents 1 hour, but I've set up this and constructed this chart so it mimics the 1 hour time frame in that structure. So this is based on volatility. There has to be some kind of a change in volatility in the structure here to create a new X in an up column or a new zero in a down column. So let me quickly explain what I did here. So there was a little range right here of consolidation. It created this level right here of resistance, and this was my triple top breakout entry to the upside. This gave me an entry at 87. All I had to do was just wait for it to break out above that range. Now remember, it's not going to create an X until there's more momentum or more volume or more activity. Then it creates another X. There has to be volatility. There has to be movement. There has to be something going on in order for it to create another X. Otherwise, it would have stayed right there inside of this little range, and it would have never broken above these other two X's that you see right here where I'm moving my cursor. So this was my entry at 87. Now, I traded it to the target of 18. A psychological level would be to trade it to the 20, which was the 1.3920 area. So I was able to squeeze out an extra pip on this trade because I could see where it was going, but you'll notice that my target lined up with a psychological level. It's also just before it breaks out above this overall range of consolidation. So how was I able to get this count? Very, very easy. Once you understand it, once you understand how to create and construct your charts based on what you're doing for the day, if you're going to day trade or if you're going to swing trade or if you're going to look for a long-term, larger investment trade, it depends. That will help you determine how you construct the chart. So in this case, I use this simple count right here. There was 5 columns, 1, 2, 3, 4, 5 columns right here. This was my first count. So this is the very first target or a minimum. This is a conservative count. I always say this. You want to have a minimum count and then you can have an overall count because you can see that there's an overall range right here that goes much, much deeper and it's much longer and wider, and that's going to give me more columns. The more columns, the further the target, but it's always accurate like this. You can see where it stopped right there at the count of 18. Now, if this continues and breaks out, I've got a further count which would incorporate this column here to the downside along with my pullback and my low. And then if it goes further, I can incorporate all of this data if I'm looking at a larger time frame, let's say the 4-hour or the daily. At the end of the day, this could give me a much larger count, but I always want to have, again, a conservative first target, which is my first minimum count. And then if it, again, breaks out and goes further, I have an overall larger count that would take me much further, approximately the 1.3980 area, and then it could go further. But right now, I can't lose. I scale out of this trade. I've already locked in profits for a total of 40 pips. Now, if you're trading one standard lot and you're earning approximately $10 a pip, that's $400. This happened relatively quick. You can see what I was talking about earlier, that if you trade this and you use this correctly, you can get in when the momentum is starting to build and there's going to be that explosive move. So I'm in the trade a lot less. My exposure to my capital in the market, in the trade, in the marketplace is a lot less, right? The exposure to the possibility of a reversal or news, you can see just how quick it was. That's what I want. I don't want to trade when it's choppy and I have to hold on to a trade for 8, 9, 10 hours. I'd rather trade when I see the momentum coming in. Point and figure gives me when, or tells me when that momentum's starting to pick back up, and it's likely to create this breakout where you see it move consistently straight to that target. Sometimes it'll take a little bit longer. There'll be some pullbacks and then it'll pop right up. But this is what happens typically time after time when I use point and figure. It is this accurate. I have videos and videos and videos of live trades inside of the live coaching call, the replays that you can watch. in addition to the modules that will teach you exactly how to set all of this up. And then I do coaching once a week. So there's a coaching call on Thursday at 4:30 Eastern Time, and we review and we talk about all of these trades. We talk about the methods that you learn inside of the modules. And then I also talk about trades that we'll be talking probably about this one tomorrow. This was a great trade, and then we'll see how this one turned out and if it hit a second target. So this is going to be a discussion that we'll talk just a few minutes when I do the live coaching. And you can have access to all of this material. It's really, really easy, and this works on any market. I use the same strategy when I trade gold, when I trade indices, when I trade stocks, when I'm investing, even when I'm looking at monthly, daily, and weekly time frames. I can do the same thing, and I can construct my charts, my point and figure charts, to mimic the daily, weekly, and monthly time frames. So I can get these big counts. I've got some trades that I'm also sharing with my coaching students. They're basically my stock picks, and it's kind of like looking over my shoulder. You can look at these trades. I actually post when I got in the trade, where my expected take profit level is. Some of these trades will return 1,000%, 300%, 400, 700%. That's the rate of return on some of these trades as a result of trading from an investment point of view. So I've got some investments as a result of using this strategy in the larger time frames. And then I can also day trade. So you can see here, here's a quick $400 if you're trading one standard lot. Really easy, really fast. It's not that difficult. And it didn't set up. This did not set up on all currency pairs that I trade or watch today. It was just this one. And it was really easy and it was really clean. I don't force anything. I don't sit there and stare at candlestick patterns when they're really choppy and going sideways. I avoid all of that, and I simply set up my charts to give me an alert when it pops up right through there, and there's my entry, and I trade it right to the target. And I know where my count is, I know where the second count is, and I know where the third count is, meaning these different targets, the first target, the second target, and the third target if it continues. So I can scale out of these trades if I want to. This is what's going to help you determine your risk to reward. I know where my stop is based on my entry, and I know where my target is, and this will tell me, am I getting a 2-for-1? Am I getting a 3-for-1? Is it going to be a 1-for-1 reward to risk ratio? And you know, some people, they don't want to touch anything that isn't less than, let's say, or isn't greater than 2-to-1 reward to risk on their trade. And this will help you identify that. I mentioned before, I didn't know how long to hold on to my trades. Sometimes I would use the Fibonacci tool and I would trade it to, like, let's say a Fibonacci extension target based on the retracement. And that works sometimes, but it didn't work all the time. This works all of the time. As long as you use it correctly, as long as you know how to find the count and you get in at the right location, this will work every single time just like this. And I'll teach you how to do that in my coaching course. Good luck, and I hope you trade well this week.